Joining me now is Mark Avallone. He's president of Potomac Wealth Advisors. I saw you shaking your head, Mark. These are confusing times.
Well, it's not easy if you want to make investment decisions based on today's headlines and look for the next week and have a certain outcome. I think it's more important to realize that on down days like today, you have to take a 6, 9, 12-month horizon or longer. And when you do that, you look at an economy that is going to slow down, and that's largely because of what we just heard about, the Fed action and the trilogy of actions they're taking, not buying bonds, raising rates, letting bonds roll off the balance sheet. That's a trifecta of factors that are going to slow the economy. But the question is, does that cause a major recession? We don't think it has to. Not all recessions are created equally. Investors need to look out longer term. And when we do that, we think there's some opportunity in stocks for those investors.
And I like the way you're kind of threading the needle here on the consumer at a time when people are debating discretionary versus staples and what's the household balance sheet and all the rest of it. One thing we know is people are traveling, and your picks are Hyatt, Hilton, and Marriott. Why?
Well, that's because I've been doing a lot of traveling, and I can tell you that these hotels are full. Now, albeit it's weekend, business travel hasn't come back as much as we'd like, but it will. There is an enormous pent-up demand. It's family celebrations, it's weddings, bachelorette parties, team events, sports, travel, soccer, you name it. People are out there filling up these hotels. And these hotels are running far more efficiently as well. Technology during COVID has improved their operating efficiency. The expectation from consumers has been lower in terms of the in-room service, and that lowers the cost structure. And I think you can't underestimate, when you give people lockdowns and fear of death with COVID, how much they want to get out and spend and how much they want that human connection. And we think travel will return and business travel will return. And that's why we like the travel sector.
Yeah, another kind of safe spot you think is going to be big cap tech, which you would add ServiceNow. I know you're a fan of Bill McDermott there and what he's done. A spec name you might pick up is DocuSign. Could you just end with the word of advice for investors who are looking at all these losses in bonds, in the market, whatever we're going to hear from the Fed next hour and beyond about tightening, and explain to them why they shouldn't just move to the sidelines or be long commodities or use their money to short bonds or any of those other strategies?
Well, we don't think most investors should take anything on the exotic side where the risk could backfire. But they have to look longer term. And that's another reason why we like big tech and growth stocks, because they are generating cash flow. They are leaders in their field. There's some stability there. There'll be volatility with all stocks, but invest in quality, and stick with your plan not to react. If you do have a bond portfolio, I don't see anything wrong with selling some of those bonds now, waiting 30 days and get back in. Capture those tax losses while you can. That's something we're trying to do for clients. And I don't think in 30 days you're going to see bonds much lower. So you can probably buy back at or around these price points and pocket a significant tax savings going forward for those equity gains that we hopefully get in the future.
Very interesting. A lot of different kinds of strategies that this environment uniquely might be a fit for. Mark, thanks for your time today.
Shepard Smith here. Thanks for watching CNBC on YouTube.